Well, hi, everybody. Hello there. Stephen Mead with Domicile real estate for people who love houses. Kind of an interesting week. I think one of the things that I love about this business is that every week seems to kind of provide data that goes in a new direction, and we get to just spend a little bit of time together and try to decipher that, see what that means, and sort of how that affects your strategy. And this week is no different. And I'm going to preface this by saying, our stats tend to never move in a straight line, meaning things jump around a lot. And that's the nature of the market. There are so many different factors that affect our real estate market here in Southern California, and they can all make a little bit of a change on things that we're seeing. And that's the reason why, even in an up market, we might not be up every single week, right? Like we might go up a little bit, then drop a little bit, et cetera. So I think the question you always ask yourself is, when you see a little bit of a reversal, does that mean we got it wrong last week? Or does it mean we're just seeing a little bit of these market variations that we're talking about? In fact, this week, I think we might even have a really good reason for that market variation. So I guess the question is, did we pop the champagne too early and returning to a market that feels a little bit more normal? Obviously, buyers are looking and clamoring for that. And this week, the numbers are a little bit of a reversal from that. So let's dive in. We'll check it out. I'll kind of go over and tell you what I am seeing in the market and what I think kind of you can come to expect in the future. So let's go ahead and dive right in. I am super excited. And just give me a second here. We're gonna go into slideshow mode for this. So let's go ahead and get that done here. Alrighty, so we are here in our data. So let's start off with our total active listings, right? If you are an entry-level buyer, a buyer under $1 million, I think the news is still super good news for you. If you'll notice, we kind of have this low point of inventory, and then we kind of slowly started rising, and then boy, we sure took a jump around the 4th of July, and now things are still rising, but leveling out a little bit. I kind of feel like this 6,000 active listings might be our new normal for under $1 million. And just as a reminder to everyone, this is based on Los Angeles and Orange counties, and this is our total active listings, right? This is what is available on the market under $1 million, regardless of property type. The red line is $1 to $2 million. And you see kind of a similar story, though things actually eased back a little bit in the last week, but still really generally good news. Both of these inventory numbers are higher than we have seen all spring. I have to think that is a very noticeable difference for buyers in the marketplace. In the case of under $1 million, it is about a 20% growth in inventory versus where we've been all spring. I think that's noticeable in the marketplace. I hope that buyers are seeing that additional choice. And obviously to our sellers, you have a little bit more competition now. You can't just put up a for sale sign in the front yard and expect 1,000 offers and bid 100 grand over list price. You're going to really have to prep your listing, make it a compelling proposition. Okay, so I think this one is also interesting, right? And what I find interesting is that both of our market categories, both of our price ranges are showing a similar shape here, whereas kind of starting new listings dove around the holiday, and then boy, did we make up for lost time, and then they've eased off a little bit. Both of these numbers of new listings in the last 14 days are still larger, really, than we've seen all week, all spring at least, right? But I think what that's telling you is that maybe this high number here, that there was a decent amount of pent-up kind of listings from the holiday still built into that number. Sellers getting excited, seeing the prices their neighbors are hitting and thinking, wow, now is finally my time. One of the things that we've talked about in the past, right, is that I personally believe that new listings on the market are directly related to how competitive the buying market is. And I know that sounds like a mouthful, but let me kind of go into what I'm talking about and why that's important for you to understand and to sort of predict maybe where our market is going to go. Normally, what dictates whether sellers put their house on the market is prices. When prices are high, sellers come out of the woodwork to sell their homes, right? This makes sense. This follows our normal supply and demand curves that you learned about in your high school or college economics classes. It makes a lot of sense. Unfortunately, in real estate, especially in the kind of market that we have, I think that's a very oversimplified view, and I don't think it's accurate. I think what dominates the market dynamic that we have is that prices are great, but what cancels that out is when would-be sellers, right? Like, let's suppose you own a home that is worth $800,000 and things have been going well for you, and you would like to buy a home that is worth $1 million to $1.1 million, right? This is normal. A lot of people might think this way. Those high prices that you're seeing for $800,000 are exactly counteracted by the high prices of what you want to buy. So it's kind of a zero-sum game. Like, that doesn't make any difference. So if we remove that out of the equation, what is it? What drives your decision to put your house on the market or not? Well, if you're a seller, one of the things you are looking at is how confident are you that you will be able to find your next home if you put yours on the market. And so when our market is super competitive like that, excuse me, when our market is super competitive, that confidence level drops. And when that confidence level drops, people don't want to put their houses on the market. And this week, our market got more competitive. And, it's a little bit of a chicken and the egg. We don't know what direction causality is running, but these two things are related. I think there was a very strong link between market competitiveness and how many people are willing to put their houses on the market. I think that if sellers don't have a lot of confidence in buying their next home, they're not going to put their house on the market. So let's go ahead and jump back in here. So what do we see happen in the last week? We eased off these highs for both of these when we're talking about new listings that came on the market. Now let's look at the flip side of this. What else happened? New escrows, they went up and we rebounded over the last 2 weeks. Now I won't spoil the surprise, but there actually is a very good reason for this behavior that will make a lot of sense to you that I think is driving this. But, obviously when you have a situation where the number of new homes coming on the market drops and the number of homes going into escrow goes up, that explains why our inventory numbers kind of leveled off like that. But it also means, look what happened to our absorption rate. So, one of the things that we talked about last week, right, was these diving absorption rates. And I said, look, understand that at least some of this diving absorption rate data is built into, the holiday weekend, and there's some of that going on. And lo and behold, we've seen kind of some rebounding numbers. I think what else is interesting is look at how close these under $1 million and 1 to 2 million numbers are. So where are we? We're in the low 80s. What does the low 80s mean? It means it is a very competitive market, not a hyper competitive market, which would be above 90%, but a very competitive market. And that's a bit of a bounce back. I think we're going to see some fluctuation in this numbers. If you look here, though, across the spring, what is our trend line, right? As prices have gone up, obviously, the sort of how no-brainer is it to buy a house? Well, that lessens, and you see this gradual weakening of the market the entire time. I think we're going to see some wild fluctuations because we're kind of hitting on this kind of a bit of the ceiling, if you will, of sort of pricing and how high things can go. However, I've got kind of a little bit of a game changer we're going to talk about towards the end of that I think that might kind of spur some additional price increases. So here are our closed prices. And I mention this every single time, but I have to do this. You are taking a look back. This is a time machine that shows you what the market was like 4 to 6 weeks ago. And what did you see? A little bit of softness across all of our price ranges. Not a drop, mind you, right? You see we have a quick acceleration and then kind of a leveling off. And that's across all of these price ranges. Our median, our upper 75th percentile, and our lower 25th percentile. And I mentioned this in our first time home buyer video, but a graph that looks like this is really, really a good thing because, if you're talking about markets and market behaviors, right? And when people are afraid of market crashes, this is the way a market crash tends to look. And if you watch our first time home buyer video, I apologize, it could be a repetition of this metaphor, but when we get into sort of scary markets, if you want to talk about kind of like a 2007 market, right? A 2007 market looked like this. It looked like a plane at the air show. And you see the biplane, they do something called a hammerhead stall. The plane goes like this, and it goes up, 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 and then it can't go up anymore, and then it falls backwards and then kind of goes down like this. That's what scary markets look like. Like the rate of increase actually accelerates to a point that is no longer sustainable, and then the market, the kind of bottom falls out. What we look at when we see these graphs, though, is not that. What we see in these price graphs is kind of a leveling off, kind of like a very gentle crest. And really, this is what we want to see. This is a market that has a lot more stability, that has a lot more rational behavior in it. And those are the markets that are not nearly as great of a risk for sudden, unexpected movements and drops. So this is another one of our kind of sort of competitive metrics. It is, we look at all the homes that came on the market in the last 14 days, and we say, how many are still available? We see this spike here. We talked about that, and then we see a drop, right? And I think what's important to note is that for both of these price categories, even where these numbers are, they are higher than they have been in the spring. I still believe we're in a market that is fundamentally less competitive than it was several months ago. And it's a little bit more like a normal looking market. Though this past week saw some increased competition, and I'm going to explain why here. This is our list to close ratio. And I kind of talked about, this is another one, right, where we can see this gentle kind of rising and then tempering, right? Boy, we kind of went through, and boy, we just accelerated as the market exceeded seller expectations and things went close for over list price. And then it's kind of leveled out up here, right? Since for about the last 2.5 months or so, it's just been kind of hovering in this area. Again, this is a sign that our market is kind of behaving in a more rational manner, which is good. Rational markets are good for buyers and sellers. And then finally, we have our days on market. We saw a little bit of a spike, and I think I told you that these were going to come back down, that I didn't think this was the beginning of a big trend, and sure enough, it wasn't. We still have a situation where I think we are in a fairly inventory constricted market. The difference now is it's not just that there aren't enough houses, it's that there aren't enough houses that people actually want. So now we have a portion of the inventory that I think is a little less desirable. What does this mean in the market when you have a market that is inventory constrained, but not by absolute numbers, right? And what I mean when I say that is, I mean that let's suppose there are 600 people who want houses and there are now 700 home buyers on the market. But the problem is of those, or 700 homes on the market, the problem is of those 700 houses, only 500 are desirable at their current price points, right? That means that those first 500 houses are going to sell like crazy, and those next 200 that are undesirable are going to sit. The great news is, if you're someone who wants to buy a fixer, right, which I think is, actually, let's do this as an example. This is great. So I will tell you what you should do if you are a buyer or a seller of a fixer. So if you're a buyer looking for a fixer, great news. Several months ago, I would have told you it's not worth it, because that price spread between a highly upgraded home and a fixer wasn't very big. So you overpaid for the fixer basically several months ago. But now we have this little bit of extra inventory, and those homes that are at that bottom of that desirability curve, there might actually be some deals in that marketplace. You'll see a wider spread between those prices. Now, what if you are a seller of a fixture? What you want to do is, if you're a seller, several months ago, I would have told you, do not put a dollar into this house. Clean it up, stage it, take nice photos. Do not upgrade the property. Not worth it. Today, my advice is different for you. Today, my advice is you really need to get your property to the next level you possibly can. And what I mean by that is, let's suppose your home is a fixer that has a couple things that are needed to make it at least move-inable. Do those things to make it move-in ready. Or maybe you're a property that has some upgrades and some unfinished projects. Finish those projects. All right, so kind of jumping back in here, our days on market have not accelerated to some unreasonable level, which I think is something people are afraid of. Mind you, if you start to see a market that is going to head downhill fast, you'll see an extended period of high days on market. Let's look at our affordability. And I think this is the graph that will tell you why our market got more competitive. Now, again, we see this gentle slope where we accelerated in the price of homes relative to 2018, and then we have leveled off in this affordability range. So again, we're seeing kind of this gentle curve, this kind of high plateau. And if you look here, this is all relative to 2018 prices, and it is the median, it is the payment on a median priced home. And I think I mentioned that kind of this is our golden zone here, this 110 to 120%. That is essentially where wages have gone since this time period. So this makes a lot of sense that this is where home prices should be. And due to some interest rate drops, that is why we're seeing this affordability, this payment level drop to only 110%. So that means the price of a median priced home today, your payment is only 10% higher than it was over 3 years ago. I definitely think the wages have moved more than 10% versus 3 years ago. In fact, we have that data for California. They have moved more than 10%. So, we're in this kind of golden range of affordability, I think, where we should be given where wages and inflation are. So do expect that being at this bottom end because of interest rates could fuel some price increases and some higher trading prices as buyers feel like, again, their buying power has gotten a little farther. And we have a graph to kind of show where we are. I mean, I think we're right around 2.8% is our running average. And yes, this enables higher prices. One of the things I tell people is this isn't brain surgery, right? Consumers make decisions just like you do. They look at what they can afford. They look at how much things are going to cost on a monthly basis, and they make decisions. If that monthly cost goes down, they feel like they can spend more, and that enables a more competitive market with rising prices. If rates go up and the payment on that house suddenly gets more expensive, they feel like they can afford less in the way of buying a home, and that ultimately affects demand for housing at certain price points. So, this stuff is not really rocket science. You just kind of have to pay attention to how people make decisions, and then it's a little bit easier to see and gauge on what's going on. Anyhow, I want to thank you guys for watching once again. We love doing these videos. They are a lot of fun for us, preparing kind of our analytics each week. I do want to urge you to like, subscribe, hit the notification bell, yada, yada, yada. But we have a really good reason for that. And that is, if you're watching us on Facebook, we're starting some video series that we put on our YouTube channel that we do not do Facebook Live with. So if you're only watching this on Facebook, you're going to miss that. We started one last week. We call it window shopping. We actually kind of go through some houses, architectural homes. That's a bit of a passion for mine. And we kind of take you through there, go over what we think about the house, what we would change, approximate cost for that, and then sort of how much do homes like these really cost to own when it comes down to the payment. So we call it window shopping. If you kind of like to look at houses, but you're not ready to kind of really go out there and look, this is kind of a fun opportunity for you. So you'll definitely want to subscribe to our channel on YouTube to see those things. Keep the comments coming. We love answering your questions. And as always, if you need to buy or sell real estate in Southern California, we would love to chat with you, give you our advice and expertise, and help you out in any way that we can. Thanks so much for watching. We will see you again on Friday for our first time home buyer market update.